Good evening, everyone. Welcome to IQI Canada's evening live talks. My name is Yousaf Iqbal, country head of Juwai, IQI Canada, and we are back with our another economic update with none other than our chief economist, Shan Saeed from Juwai, IQI. Hey, Shan, good morning. How are you doing?
Good morning, Yusuf from Kuala Lumpur. It's a beautiful weather right now. It's cloudy. It's 11 o'clock in the morning, and I hope you are doing good in Toronto. I have been hearing good news for the Canadian real estate market during pandemic. As of today, the market has gone up by 26%. And I was this morning on Astro Avani, and I shared the same that we at Juwai IQI are quite bullish and buoyant on the market. And our man Yousaf Iqbal is doing a lot of hard work with his team, and he's carrying the flag very, very high. So I spoke about Canadian real estate market, Dubai real estate market, and overall the KL
Wow.
market today.
Wow. Thank you so much, Sean, for your kind words. You right, real estate market has been doing good. With the new interest rates coming up, which will be some of my questions I'll be asking you. We saw a little bit of slowdown, but the overall market from year to year, we're still seeing a good increase in the market. And again, as always, like to quote, you're saying that where do you want to invest your money? What you could get hold of your hands is the tangible assets and definitely we will talk about it. So, Shan Saeed, I know that you're just talking about the top TV channel in Malaysia right now on the Astro One that you were live on it, which is really amazing. Also, what I like to know is that you shared a little bit about it, but then uh, you know Real Estate as a New Global Currency, the book you written before as well, and why sophisticated and smart investors are moving their funds in tangible assets. So, Shan, like media is following your narrative, and this is a major accomplishment of your global ideas as well. So, let me share the poster to our valued listeners in the audience as well. Do you want to just talk a little bit about this?
Yes, finally, as Yusuf, you mentioned that press and media have bought our narrative and they understand when we say new global currency real estate. And now everybody's talking about tangible assets. And 1970 is back, history is repeating after 52 years. And most of those, as you mentioned, sophisticated and smart investors have come to realize that going into tangible assets would give you peace of mind. So you have a choice. You go for peace of mind or you want to have sleepless nights. So finally, I think it was well appreciated. And Astro Avani has recently mentioned to me that the program New Global Macroeconomic Outlook, which Shan Saeed has picked up momentum. There has been a lot of interest in the market because we share facts and figures. No Cinderella stories, no James Bond stories, no tabloid stories. And investors nowadays they want to listen to hard facts. What is going on? And during the today's program, I mentioned that property prices during pandemic in Canada has gone up by 26%. And I quoted Economist magazine 14th May issue of this year. And look at New Zealand again, the prices have gone up by 46% year to date post pandemic. So I think that clearly indicates that market is looking for some solid deals, and real estate is providing a real hedge against inflation. Inflation is showing its head, and for the next 2 years, I wouldn't be surprised if inflation remains strong, and we can only expect the global economy to recover in 2025. So yes, real estate is becoming a new global currency, and it is giving peace of mind to those smart investors.
I must say that, Sean, I remember that book. I wish I had the book right now to show to people that, real estate, the new global currency. That was in 2014, I believe, or 2015 when you wrote that book,
15.
right? 15,
15.
see? So thank you so much for that. Now people are realizing that how the global currency is changing and is taking a stand in terms of the real estate assets on that. So, Sean, coming to straight to my questions, like Fed has been building this narrative that they will be able to control inflation. But Fed was supposed to start some quantitative tightening in June 2022. However, no quantitative tightening has materialized yet, with the Fed's balance sheet remaining unchanged to US dollar 8.9 trillion. Anyone has a clue like what's going on? Do you think like inflation will remain subdued for next year as well?
You said the way Fed has positioned itself, I think that the market believes that Fed will continue to raise rates from here. And as you mentioned, whether it's 75 basis point or 100 basis point this week, I think 7500 looks very pragmatic, and Fed is on course that till December 22 they will continue to raise rates. And according to my global networking, we expect the discount rate to touch 3% by December 2022. So
Wow.
once we have 3% discount rate, I think the markets will have to adjust themselves according to the new norm of higher discount rate. Not only Fed, but many central banks are raising rates, and year to date, 41 central banks have raised their rates. So, and look at Europe as well; they have also raised rates. So, we at Juwai IQI expect Fed to continue to raise rates because inflation will remain strong. Already, inflation is close to 10%. It's very close to 9.4 right now. So once it hits double digit, that will be a concern for many investors. And Fed is aware of the inflationary risk and recessionary risk that is coming into the economy. So inflationary recession is going to hit many economies going forward, and more and more investors and people, they have come to realize that inflation is serious, is stubborn, and we have to protect our wealth. And wealth preservation has become the key strategic intent of many global smart and sophisticated investors. And in order to preserve wealth, if you can maintain your capital, preserve your capital, and if you can get some interest rate on top of that, capital, I think that is a big achievement in this market, because markets are very volatile. Stock market is sinking, and lot of investors, they are moving from traditional assets, that is stocks, bonds, and cash, to into alternative assets, that is real estate, gold, arts, vineyards, farmlands, private equity deals. So I think 75 to 100 basis points would be pragmatic this week, and Fed will continue to take control of this inflation, but inflation will stay high for this year.
Sean, that brings me to my next question. With the Fed increasing the rates, as you just now mentioned, to 75 to 100 basis point this week, do you think like market expecting that Fed rate hikes would create recession to control inflation? Is this a new monetary policy outlook for the markets to fathom, or is like meaning recession is not bad?
Sometimes I would say recession is not bad. What you just mentioned, globally, a lot of discourse is now happening. We started with stagflation, and then we moved into recession, and then going forward next year, we can expect QE 5. So the Fed strategy at the moment, I think it is making sense now to a lot of investors. What Fed is trying to do, they're raising rates. So once they raise rates, the economy slows down, recession hits the economy, consumption goes down, the prices come down. The prices come down, that gives an advantage for consumers to go back, and they start making purchases. But with elevated and higher prices, obviously the consumers, they feel the heat, they feel the pressure of inflationary outlook. So what the Fed is trying to do in order to control inflation, they want to control inflation through recession. So recession, once the recession hits the economy, the consumption, the prices will come down. Consumption goes down, prices come down. Then consumers will have a choice to wait for the market and the inflation to come down. Once the inflation comes down, that will give a kickstart to Fed and other central banks to lower rates next year. Once you lower it, then it will again build the momentum. So I think, in my opinion, what the Fed strategy is, to control inflation, they will bring in recession. So recession to me is not bad. So recession is good, and this could be a game-changing strategy in the market, and this could be a new phenomena in the economic and financial markets, that in order to control inflation, you hike the interest rate, you bring in recession, it lowers consumption. One, it lowers consumption, it brings down the inflation. So Fed's financial and business model is making sense, and it could bear fruit, not this year, but I think next year we can see. That's why we said, we expect global economy to recover by 2025. So any policy instrument that Fed undertakes, it takes good 12 to 15 months for that policy instrument or that policy lever to make an impact on the economy. You cannot just control inflation overnight, or in 1 week or 1 month or 2 months or 3 months. It gets controlled, it gets under pressure, a good 12 to 15 months. So we expect economy to remain in an uncertain mode, and Fed strategy, you never know, it could work out. Right at the moment, I have a feeling, and what I have been sharing with many of my people in my networking, that Fed strategy can work, but it can only work in 2024. So next year we will have higher inflation because oil prices will stay higher, they will remain elevated, and once oil prices stay higher, obviously it will boost the inflationary outlook, and it can only happen once oil prices go down, recession comes in, and then the prices come down, the consumption patterns come down, and then we can see inflation going back into the new mode.
Wow. So you think like inflation by itself, by the time very well mentioned that whatever new policy which is taken into effect is something for people to understand is that it's not something which is going to change overnight, as Shan said right now. It could take up to 12 to 15 months to see the results on that. Very one interesting point you also raises that once we have the inflation going in control, then we would probably see the interest rates probably coming a little bit down on that. Before that takes me to my third question to you. Basically, like after Fed, with 9 trillion balance sheet, let's talk about the Europe trade, like European Central Bank hikes interest rates, and the markets have got perplexed. Like ECB hikes rules first time in 11 years, 50 basis points increase to 0.0%. South Africa, the hike rate for the fifth time in the year, 75 basis points increased to 5.50. Hungary raised 200 basis points. Pakistan raised 125 basis rate. Like, is this a new race for rate hike? Can anyone make economic and financial sense? Because all I'm looking at is that from everywhere, it was like nobody was maintaining any interest rate throughout the time, and now all of a sudden it's like a race. Everybody wants to keep changing interest rate. What's going on, Chan?
Yes, Yusuf, very important question. I think you have raised a very valid question, that everybody is in a race because inflation remains stubborn and inflation remains serious. And in order to control inflation, in order to reduce the inflationary outlook, you have two strategies. Either you raise rates, or you control inflation through appreciating through your currency. Right now, all the central banks, they are raising rates, and as I mentioned earlier, that the only choice the central banks now have is control inflation through recession. So recession, once the recession hits the economy, then the prices will come down, consumption patterns will come down, there will be a slowdown in the economy, and then once the economy slows down, then the central banks will lower rates. Once the central bank lower rates, it will induce consumers to spend more, the businesses will invest more, and then the consumption pattern will come back to the normal. So I think Europe has raised rates after 11 years. It's a very long period of time. 50 basis point, it clearly indicates that even in Europe the inflation is above 9%. They want to control inflation as well, and this is both cost push and demand pull inflation. And after pandemic, a lot of economies are struggling, and they are struggling because the demand stays high. There are supply constraints, geopolitical risk, uncertainty. The economies remain under a lot of pressure. So I think this is one of the ways the central banks globally, they want to control inflation through recession. And this is a new strategy. And in my opinion, this is a very novel, very innovative, a very strategic move from central bank after understanding the market. We might criticize and say central banks are not doing good, but I think the way I see things and way I understand the way central bankers and the governors central banks globally are thinking, this strategy could work. And once this strategy could work, then we can expect it goes into the mainstream. And the only way the books and the articles will be published, that in order to control inflation, you have to hike interest rate. Once you hike the interest rate, recession comes in, economy slows down, consumption goes down. And once the bank starts, the banks, central banks start going into QE. So this strategy can work. I think it will work, but not overnight. It takes time. So next year, we at Juwai IQA expect that global central banks, they will start lowering rates. And we have already mentioned in our April 22 newsletter, and I was also sharing with Lily in Australia, that Lily, you need to share more of the newsletter with your valued and sophisticated and smart investors
Yeah.
in Australia. And Lily is very much on the same page as I am. And she said, yes. So everything what I'm sharing with you is documented. We mentioned about stagflation, recession, and QE5 in a newsletter of November of April 2022. And the beauty of this newsletter is that investors can always go back and say, Shan, you said this. And I can say, oh, yes, I said this. So we can go wrong as well. It is not a
Yes.
problem. But at the same time, if we hit the spot and if we are spot on, I always say that people in my networking are smarter than me. I'm not smart, I'm still learning. But I think a lot of people who are following us, they expect IQI to share market intelligence report so that they stay ahead of the market.
So people who just joined us right now, we are live with Shan Saeed on our economic update. If you have any questions, any comments, do let us know. We would love to hear from you. And at the same time, what Shan is right now mentioning is about our monthly newsletter. That's a copy which we give it to all smart and sophisticated investors. We talk about economic update. We talk about what's going around the world, what's happening in the economies, what's happening in the countries on that. Interestingly, we were having a meeting and we were talking about Vietnam. The Vietnam was going really good on that. So if you want to really, invest somewhere or understand at least where the economy is going, where the market is going, you know, do ask us for our newsletter. You can just put up a comment here right now, newsletter, and somebody from my team will contact you and definitely would love to give you a copy of our newsletter, which is being printed every month. And of course, we have yours truly, Shan Saeed's section in that, which is again tells like whatever the predictions or whatever we've been talking about is actually coming along with it. So this is actually good news, Shan. For my investors, what you just now said is that expecting that by next year interest rates may start coming down on that, and that's what we've been talking to our smart and sophisticated investors at the same time, that when we are asking or telling you something on that, we don't act like salesperson, we don't act like salespeople, we act your advisors. And the reason we're able to advise is people like Mr. Shan Saeed, or chief economist on that, he gives us the insight of what's going to happen around the world, what is the expected outcome of the things around the world, what's happening right now, what people should hold on to, and how people should be spending their money, they should be doing on that. So do contact, Team IQI Canada, because, when we give you any advice, it's actually coming up from a market intelligence report, people like Shan Saeed, who's been advising us, and that's how we help our sophisticated and smart investor to make decision on that. So then just a little note from my side. So Shan, my next question to you is that emerging markets, advanced economies, Africa and Asia, all economies are facing challenges. The sovereign debt risk has become a new headache for the global economy. After Sri Lanka, who's next in line?
Oh, it's a very challenging question. In 2020, I still remember Greece had this sovereign debt crisis. It all started with Greece in Europe.
Yeah.
And if you recall, there was this acronym of PIGS,
Yeah.
PIIGS, Portugal, Ireland, Italy, Greece, and Spain at that
Yeah.
time. And
Yeah.
if you recall, 30th June 2015, the Greece central banks put a moratorium for all those bank account holders. You cannot withdraw more than 60 euros. Even if you had 1 million euros in your bank account,
True.
you cannot withdraw more than 60 euros. So
Yeah.
that was a trouble spot for Greece. And after that, you had many countries. Last year it was Lebanon, and this year it was Sri Lanka. And the way things are shaping up post pandemic, I think a lot of countries are facing problem because of higher debt. The debt, global debt has touched $300 trillion. The global GDP is $100 trillion. So global debt is three times of global GDP size, and that is massive. And this morning when I was sharing with Astro Avani, I shared the same, that countries, they need to manage their debts. And even in today's Star newspaper, I have been cited. So this is a very important juncture of many economies, how to increase your revenue and decrease cost, because you cannot just go on taking on debt. Ultimately you have to pay off your debt. It is not like you can go and ask multilateral institutions that write off my debt. That lowers your credibility. It is just like I go to RBC, Royal Bank of Canada, and I borrow 10,000 Canadian dollar from them. And after 2 months, I go to RBC and I say, I don't have the capacity, please write off my debt. That is not possible, because
True.
most of my information is shared with all the banks. And Bank of Canada has got my data, for example. So I think it lowers my credibility, it lowers my integrity. Let if I go to another bank, CIBC, and say I want 5,000 of a loan, they first check that they're going to do that. You have already borrowed $10,000 from RBC and you have not returned that. How can we lend you $5,000? So it's very important for countries that instead of writing off, they pay off the debts. That will show the financial credibility of that country, that will improve their standing in the market, that will improve their rating in the sovereign wealth, sovereign countries. So I think sovereign debt risk has become a new global challenge for many institutional, multilateral institutions and countries. They need to understand that they need to have macroeconomic stability. The graph that you have shared from Bloomberg, it is clearly an indicator that investors, they need to understand the country's outlook, and in order to build consumption, it's very important to have macroeconomic stability. Just like Canada, despite higher interest rate, 2.5% discount rate, Canada witnessed post pandemic 26% rise in the housing market. It clearly indicates that market is still very strong. The Canadian government has done a strategic uh, positioning of the country of having macroeconomic stability, having world class education, having a lifestyle, and most importantly, they have good housing market which attracts global investors. So positioning of the country is very important, plus the stability of the market. Once you have stability in the market, investors come to those countries where the market is strong, it is structured, it is matured, but most importantly it has got stability. It is giving capital appreciation, it is giving strong rental yields, so that they think of long term. Real estate market, as I always say, it is 10 to 15 year cycle. It is not a 1 day cycle or a 1 year cycle. You buy a property today, sell it tomorrow. It's not like that. You can't flip it so quickly. You have to maintain this asset, and real estate has become the new global currency. Things are getting very, very challenging in the global economic outlook. And as Yusuf and I have always shared, in tough times, the only fixed asset that goes up is land. It gives you peace of mind. You can touch the walls of your house. That is your own. But if you talk about cryptos are all in the air. They don't know which space, whether it's Pluto or Mars or Earth or Jupiter. Nobody knows about Bitcoin. But for land, it is tangible. You can go, you can visit your land, you can build whatever you want. So in tough times, the only fixed asset that goes up is land. And there was a saying when I was in Chicago: in tough times, home is the safest place.
True. Very, 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 very true. You rightly mentioned, San, that in the passive time, something which you've really seen going up is the land, where people are, coming in. So I always like to always put up a graph, or show a little chart which says that the way the population is growing. So there's a world map population which shows that how the population is growing every second as compared to people, who are born and people who are dying. And then, to bring that point of yours is that the land is not growing. The land is still limited. But the number of people and population is growing on that. So more
Yes,
you have
yes,
in your hands on your land on that, you will see that asset grow up. So,
yes,
but you
Yusuf.
said, yeah,
Yusuf, you're absolutely right. This is a very valid point. The demographics. Land is limited, population is growing. So what the population is going to do, they will obviously look for land. So the
yeah,
supply is limited, demand is high. So demand is here, supply is here, the gap is so much. Obviously the investors will demand. Everybody wants to have a shelter. Everybody wants to have, a good house, a good apartment. So I think this real estate will continue to be on the global investors radar. And it is one of those asset classes that have not been visible for last in the last 5 to 10 years, but now it is getting more prestige. It is getting more attention from those, as you mentioned, sophisticated and smart investors. And as we say, real estate will be the new global currency.
that's true, Sean. So let's talk a little bit, deep. Uh, let's get a little bit deep and analyze the Canada's market outlook as well, which is always I would like to hear from you. The China, as it's with rising inflation. The Bank of Canada has made a move in hiking it to 100 basis point, which was not expected. You were expecting it would be a little bit 0.5, 0.75, but when 100 basis came in, it just came as a surprise to us on that. And, of course, the reasons to fight the inflation on it. The discount rate stands at 2.5%. It brings our prime rate to 4.70%. Do you think like central bank can manage this challenge? And how about the real estate rates in the market in H2 of 2022?
I think, in my opinion, what Bank of Canada has done, they have made a preemptive move because they expect inflation to remain high. In my opinion, it's a good move. Yes, 100 basis point in one go is too much for especially the mortgage market. People, they are taken off guard and they don't really know.
Yes.
But overall, if you recall, and I would urge you, Yusuf, last month, 14th June, Economist magazine ran article about the real estate market, and Canada was right on the top. If you had invested $100 in 2000, in 2021 that $100 have touched 325%, three
Wow.
times increase. And
Yep.
Canada was right on the top. Then you had UK, US, and other countries. So I think, in my opinion, as I said, Canada has really positioned herself in a way that everybody has a feeling, investors generally speaking, that Canada is a very safe country. Security wise, education wise, healthcare wise. My own school teacher went, his family is based in Toronto. He goes to Canada, and every time he comes back after 1 month or 1.5 month vacation, he says, Shan, it is so peaceful in Toronto. The things are so smooth. The education, the school, the healthcare, people going to the job market, everything is so smooth. So I feel that there is a lot of stability in Canada. Plus, the most important thing, who drives the market? People. Who
Yep.
drives the economy? People are educated, they are civilized. So economy only moves ahead, especially where you have people who are civilized, they're educated, they're tech savvy, like many other countries. Canada, being the advanced economy, especially in North America, has got huge advantage. and we have seen the market has become very strong. Only today, I was asked by Astrovani that average home price in Canada has touched $1 million. And as of 3 years ago, it was trading at $750,000. And now the average home price in Canada, in Cambridge, in Mississauga, anywhere, it is $1 million. Everybody has become a millionaire.
Yes,
So,
that's true.
so, as, so to speak. So the market will stay stable. Yes, with interest rate hike, there will be a little pause because investors they need to understand at what rate they will be able to book their deals and at what rate they will be able to strike deal with the banks in order to get loan from the bank. But still I would say 4.75, it's a good opportunity because the interest rates will go up till year end, and once you lock in your mortgage loan at this rate, it could be beneficial for you. And it's an ideal time because the prices are going up. They might slow down in the short term, maybe 2 3 months, but investors are coming. Canadian government is going to welcome 1.2 million people in the next 2.5 3 years. So how those 1.2 million people are going to live? They will not be living on roads. Obviously
That's
they
right.
need shelter, they need homes. So I think the supply will have to come up in order to meet demand. And I wouldn't be surprised. I'm making a forecast in the next 2 years. The average home price of Canada will be between 1.1 and $1.2 million.
Absolutely right. Shan, you very well said that in terms of the pricing from 750, I've been seeing it for the last 10 years, the way market has been behaving. There's always a cyclical adjustment which happens in the market on that. Average price in Canada, yes, 1 million. If you talk about GTA, you rightly mentioned the average price has already gone to 1.2, 1.3 million. In the next 2 years, we're seeing a couple of $1,000 going up on that. Talking about the interest rate, and before that, I go to the supply and demand part of it on that. You're absolutely right. The population which is coming here to Canada, there is still a low shortage of supply and a very high demand. And we see that happening right now in the rental market as well. The rental market and the rentals are coming out very, very strong right now. You put up a market for lease, you got, within 4 days, 5 days, you got about 20 to 30 people looking for a rental property, and that is giving up a very good rental yield right now to the investors as well. Talking about the interest rate, I'm just going to read out a little email which I got from CIBC saying that they are offering a 4-year special mortgage rate, for 4.99% for a closed mortgage. So banks have started already doing that. What to your point, when you said, that investors will be looking and locking up their deals and locking up their things on that. We can see right now that even the banks are coming up with these kind of promotions at the same time as well to see people who are looking to lock in their interest rate, they'll be able to lock in this interest rate. Yes, a year from before or 2 years before, anybody who was offering 2.9%, 2.75%, oh no, that's too high, man, forget it. I can get 0.99 from HSBC, I can get 1.29 from CIBC, I can get 1.39 from RBC, but the time has changed now. So again, as you rightly mentioned, if people are really looking to lock in their interest rate, they would be at an advantage in case the rates continue to go up on that. So I agree with you that the Canadian market has been strong. It will be a cyclic adjustment as the interest rates goes up, but I totally believe myself as well. That a balanced market approach is very very important. At the same time, we were seeing it. When supply was really short and the demand was going like crazy, people were just buying stuff and without even realizing, doing their home inspection on that. And that is the time when Team IQI Canada has been telling all their investors and their clients, do not just jump into a deal. Just do not go blindly and buy into a deal. Look for it, wait for it on that. I'm very proud to say that each and every of our team members does the same thing. None of them, really goes and pushes the things, for people to go and do that on that. So, so thank you very much for that. So, Sean, anything else you want to add before we say bye to our audience?
I still remember a year and a half. You mentioned, Shan, HSBC is offering 0.99%. And I said, Yusuf, it is so cheap. If you're getting a mortgage loan at 1%, And I think all the banks, what I have very high regards and respect for CIBC, one of the top banks in Canada. RBC, I have few friends, a lot of people from Bank of Canada, especially working for Central Bank. They are following me on LinkedIn, and I'm glad a lot of central bankers from ECB, Fed, they are following me on LinkedIn. But as you rightly mentioned, you have to analyze the market and what your agents are doing. They are having an engagement strategy with those clients instead of pushing them, giving them the market scenario. And I would request you, Yusuf, that you should share all these newsletters
Sure.
with your valued investors, that see what we said in 2020, what we said in 2019, 2021, and onwards. This is happening. We may not be 100% correct all the time, but we have shared our forecast based on market intelligence report. And 60% of the time, I'm very conservative over here, we have been on the dot. We cannot be 100%. If somebody claims that we are 100%, absolutely wrong. So I think the newsletter will give your valued investors a global approach. We at IQI, we always believe to have a global perspective, bring it down to specific country, and then share the insight what is happening in Philippines or Vietnam or Malaysia or Australia or Canada or Qatar or Portugal or Greece or Dubai. So I think newsletter will be a good thing, and more investors, if they can peruse and read our newsletter, they will understand how we actually think. And you are leading from the forefront. You will also you have I've seen you stay engaged with your valued investors. It's very important. Last thing what I will say, in these tough times, investors are only looking for that person who can hold his or her hand. If you leave your investors high and dry, okay, now I have sold my property, thank you, goodbye, Yusuf. No, no, no. You have to stay engaged. You have to hold your clients, continue to provide an updated market intelligence, as we call it, boots on the ground information, and share with them what is happening, so that the investors, they know that okay, Yusuf or Bob or others, they are sharing a market intelligence report. They are keeping us up to date about financial market, commodities, real estate, not only about Canada but globally. They will come back to you. So repeat sales should be the strategic intent of all the agents. Thank you.
Thank you so much, Sean. And before I end, what I'd like to say is that what Sean just now mentioned is that in terms of educating our agents, our warriors, and our clients, every Tuesday, which we call as a terrific Tuesday here in Canada, we have different speakers who come and talk. This week we've got Scotiabank coming in, and last week we had CIBC coming in here. And the idea behind is that it's about talking about the market intelligence report, what's happening in the market, how people can utilize their funds, how they could actually look in this time as well if they're looking for refinancing, any other options of that. So for any information, whether it's related to real estate, you're looking for any advisors, do contact Team IQI Canada for this. Sean, thank you so much. Always, pleasure having you on our show, and it's always good to hear from you for all the insights. And I always look forward for this, and I keep following Sean on LinkedIn and on Facebook and Instagram. If you guys are not following it, I'm telling you right now, go look for Shan Saeed and follow him up if you really want to know what's happening around the world, what's happening in the market. And again, all these reports which we are sharing with you guys, market intelligence report, comes from us, none other than our own chief economist, Shan Saeed, which helps our smart and sophisticated investors to make their investment possibilities on that. So thank you very much, everyone. Thank you, Shan. Take care of yourself, and I'll see you next month. Take care. Bye.